While everyone's been focused on falling house prices and doom-laden predictions, something extraordinary has been unfolding in the UK property market. The data that just dropped reveals a transformation so significant that it's rewriting everything we thought we knew about the British housing crisis. Major cities are experiencing price surges that economists weren't predicting. First-time buyers are suddenly finding opportunities where there were none, and the regions leading this recovery aren't the ones you'd expect. What's driving this unexpected shift? And more importantly, why has it been flying under the radar while headlines continue to paint a picture of decline? The truth is more complex and far more interesting than the simple narrative we've been sold. If you want to stay ahead of the game and understand what's really happening in UK property and the economy, hit that like button and subscribe to Property Reporter. We cut through the noise to bring you the facts that actually matter. The numbers coming out of the Office for National Statistics paint a picture that contradicts almost every conversation happening around dinner tables and in office break rooms across the country. UK house prices jumped by 1.3% in February alone, the strongest monthly gain in over 2 years. That single-month increase erased nearly all the losses from the previous year's decline, pushing the average property value to £293,000. This isn't a minor adjustment or statistical anomaly. This represents the fastest acceleration since November 2022, right before the market turbulence that followed the disastrous mini-budget. Annual price growth now sits at 3.4%, a dramatic reversal from the negative territory we saw just months ago. The speed of this turnaround has caught analysts completely off guard, with many still publishing forecasts based on outdated assumptions about continued decline. What makes this recovery particularly fascinating is where it's happening. London, often seen as the bellwether for the entire UK market, recorded gains of 4.1% over the year, but it's not leading the pack anymore. The northwest of England surged ahead with annual growth of 5.3%, marking the strongest regional performance in the country. Cities like Manchester, Liverpool, and Preston are experiencing demand levels that exceed anything seen in the past 5 years. Meanwhile, the East Midlands posted growth of 4.8%, with Nottingham and Leicester seeing bidding wars for properties that would have languished on the market a year ago. Even more surprising, Scotland's housing market grew by 4.2% annually, with Glasgow and Edinburgh both recording substantial gains despite predictions of stagnation. The traditional power dynamic of the UK property market, where London dictated trends and everywhere else followed, has been completely upended. The driving force behind this unexpected boom comes down to something deceptively simple yet incredibly powerful. Mortgage rates have been falling. The average 2-year fixed-rate mortgage dropped to 4.68%, down from peaks of 6% just months earlier. 5-year fixed deals now average 4.39%, nearly a full percentage point lower than their recent highs. For a typical buyer borrowing £250,000, this translates into savings of roughly £150 per month compared to rates available in late 2023. These aren't marginal differences that buyers barely notice. These are substantial improvements that fundamentally change affordability calculations and put properties within reach that were previously impossible to finance. Lenders have been competing aggressively for business, with major banks launching rate wars that have accelerated the decline in borrowing costs. This competition intensified throughout early 2024 as banks anticipated further base rate cuts from the Bank of England. First-time buyers, the group most devastated by the combination of high prices and elevated interest rates, are flooding back into the market in numbers that astonished industry observers. Mortgage approvals for house purchases reached 69,700 in January, the highest level since August 2022. Applications from first-time buyers specifically jumped by 18% compared to the same period last year, representing tens of thousands of young people and families finally able to step onto the property ladder. Estate agents report that viewings from first-time buyers have doubled in some regions, with many properties receiving multiple offers within days of listing. The psychological shift cannot be overstated. For years, an entire generation watched property ownership drift further from possibility with each passing month. that despair has transformed into cautious optimism and, in many cases, urgent action as buyers rush to capitalize on improving conditions before they potentially worsen again. Help to Buy equity loans, which closed to new applications in October 2023, created a sense of now or never urgency for those who had been sitting on the fence. But mortgage rates tell only part of the story. Wage growth, running at a robust 5.6% annually, has created a situation where household incomes are rising faster than house prices in many regions for the first time in decades. A typical household in the Northwest earning the median wage has seen their purchasing power increase by roughly £8,000 over the past year, when accounting for both wage rises and improved mortgage terms. In the East Midlands, similar dynamics are playing out, with wages rising sharply in cities with growing tech and manufacturing sectors. This represents a fundamental shift in the affordability equation that transcends simple price movements. Even as property values climb, the actual burden of home ownership relative to income has been decreasing for a significant portion of the population. This explains why demand remains strong even as prices accelerate, a phenomenon that would seem contradictory in a normal market environment. Workers in sectors like technology, healthcare, and skilled trades have seen particularly strong wage increases, giving them substantially more borrowing capacity than they had even a year ago. The rental market dynamics have added another layer of complexity to this property revival. Private rents increased by 9.7% annually as of January, vastly outpacing house price growth and creating a situation where buying has become genuinely cheaper than renting in numerous areas. A typical three-bedroom house in Manchester that rents for £1,400 monthly can be purchased with mortgage, e-payments of approximately £1,100 at current rates with a 15% deposit. The same calculation holds true across Liverpool, Nottingham, Derby, and dozens of smaller cities throughout the Midlands and North. Renters looking at their monthly outgoings are making rational economic decisions to buy rather than continue throwing money at landlords, even if it means stretching financially in the short term. This exodus from the rental sector into ownership has created sustained demand that supports higher property values while simultaneously putting downward pressure on rental yields, potentially moderating future rent increases. The supply side of the equation remains painfully tight, amplifying every increase in demand into sharper price movements. The number of properties available for sale sits roughly 30% below pre-pandemic levels, with many homeowners who secured ultra-low fixed-rate mortgages between 2020 and 2021 refusing to move until absolutely necessary. Someone locked into a 1.5% mortgage for 5 years faces the prospect of doubling or tripling their monthly payment if they move, creating a powerful disincentive to list their property regardless of changing life circumstances. New construction has failed to fill the gap, with housing completions running at roughly 170,000 units annually against a widely accepted need for 300,000. Planning restrictions, material costs, and labour shortages have prevented builders from ramping up production, even as demand signals strengthen. The result is a market where every motivated buyer competes for a limited pool of available properties, pushing prices upward even in areas where economic fundamentals might suggest more modest growth. Regional variations reveal just how uneven this recovery has been, and hint at where opportunities and risks lie going forward. Northern Ireland recorded the weakest annual growth at just 1.4%, still recovering from more severe declines in prior years. Wales saw respectable gains of 3.9%, but within Wales, the differences between Cardiff and rural areas are stark. The South West, traditionally a strong performer, posted 3.3% growth, held back by affordability constraints in popular coastal towns where prices remained elevated even during the broader downturn. Within London, the variations are equally dramatic. Inner London boroughs like Hackney and Southwark saw gains exceeding 6%, while outer zones, and particularly the commuter belt areas in the southeast, lagged significantly. This creates a patchwork market where generalisations become almost meaningless, and success depends on understanding micro-level dynamics in specific postcodes rather than broad regional trends. The political dimension adds another layer of intrigue to this property resurgence. With a general election looming, housing has become a central battleground issue, and government policies could dramatically reshape market conditions regardless of underlying economic factors. Labour has pledged to build 1.5 million homes over 5 years if elected, a commitment that would require substantially ramping up construction and potentially reforming planning laws that have constrained development for decades. The Conservative government has promoted various schemes to support home ownership, though CRI Yates. Critics argue these measures inflate demand without addressing supply constraints. Stamp duty thresholds, help to buy programs, and first-time buyer incentives all face uncertain futures depending on election outcomes. Savvy buyers and investors are watching political developments as closely as economic data, knowing that policy changes could either accelerate the current recovery or bring it to an abrupt halt. International buyers have begun returning to the UK market after a period of retreat, adding another demand source that particularly impacts London and other major cities. The weakness of the pound against the dollar and euro has made UK property relatively affordable for overseas buyers, especially those from the United States and European Union countries. Chinese buyers, once a dominant force in the London luxury market, remain largely absent due to capital controls and economic uncertainty at home. However, buyers from the Middle East have increased their activity substantially, with wealthy individuals from Saudi Arabia, the United Arab Emirates, and Qatar viewing London property as a stable investment amid regional instability. This international demand primarily affects the top end of the market, but it creates ripple effects throughout the price spectrum as domestic buyers priced out of prime locations shift their attention to more affordable areas, pushing up values in previously overlooked neighbourhoods. The mortgage market itself has evolved in ways that support this property revival beyond simple rate reductions. Lenders have increased their maximum loan-to-income ratios, with some now offering mortgages up to 5.5 times annual salary for borrowers with strong credit profiles. This effectively increases purchasing power by tens of thousands of pounds for many buyers, allowing them to compete for properties that would have been beyond their reach under more conservative lending standards. Product innovation has accelerated, with longer fixed-rate terms becoming more common, and some lenders offering 10 or even 15-year fixes that provide certainty in an uncertain economic environment. Green mortgages, offering preferential rates for energy-efficient properties, have gained traction and are beginning to create a two-tier market where homes with poor energy performance certificates trade at discounts, while efficient properties command premiums. First-time buyer-exclusive deals with reduced deposit requirements have proliferated as lenders compete for business in this newly active segment. Economic forecasters who predicted continued house price declines through 2024 are now scrambling to revise their models and explain what they missed. The consensus view, as recently as December 2023, called for prices to fall by 2 to 5% across the year, with some particularly bearish analysts predicting declines approaching 10% in overheated markets. Instead, we've seen robust growth that, if sustained, would result in annual gains potentially reaching 5 to 7% by year-end. What these forecasters underestimated was the resilience of the UK labour market, the speed at which mortgage rates would decline, and the pent-up demand from buyers who delayed purchases during the uncertainty of 2023. They also failed to adequately account for the supply constraints that would amplify any demand recovery into price increases. The forecasting errors have been tangible enough that some analysts now question whether the models used to predict house prices adequately capture the behavioural and psychological factors that drive real estate markets, as opposed to the purely financial variables they typically emphasise. The Bank of England faces an increasingly difficult balancing act as this property recovery gains momentum. On one hand, economic growth remains sluggish, and inflation has fallen toward the 2% target, creating conditions that would normally justify interest rate cuts to stimulate the broader economy. On the other hand, a surging property market risks creating the kind of asset price inflation that could spill over into consumer prices and wage demands, potentially requiring tighter rather than looser monetary policy. Governor Andrew Bailey has hinted that rate cuts are coming, with market expectations now pricing in 2 to 3 quarter-point reductions by the end of 2024. However, if house price growth continues at the current pace, the bank might delay or moderate those cuts to avoid overheating the property market. This creates enormous uncertainty for buyers trying to time their purchases and for the market overall, as expectations about future rate movements drive current behaviour in self-reinforcing cycles. The build-to-rent sector has emerged as a wild card that could significantly impact future market dynamics. Institutional investors have poured billions into purpose-built rental developments across major UK cities, creating a professional landlord class that operates very differently from traditional buy-to-let investors. These developments offer amenities and management standards that appeal particularly to young professionals who might otherwise be first-time buyers. If the build-to-rent sector expands rapidly enough, it could siphon off demand from the for-sale market, potentially moderating price growth. However, the current evidence suggests that build-to-rent primarily competes with traditional rental housing rather than home ownership, meaning its impact on house prices may be limited. The sector does contribute to overall housing supply though, and any addition to the housing stock theoretically reduces pressure on prices across all tenures. Regional economic development strategies are reshaping where people want to live, and consequently where property demand concentrates. The Northern Powerhouse Initiative, despite mixed results overall, has channeled investment into Manchester, Leeds, and Liverpool that has improved infrastructure and attracted businesses, making these cities genuinely more desirable places to live. The Midlands Engine programme has similarly boosted cities like Birmingham, Nottingham, and Derby. These aren't just marketing slogans, but represent real economic shifts that support sustainable property price growth rather than speculation-driven bubbles. Companies relocating offices out of London to reduce costs have created well-paying jobs in regional cities, attracting exactly the kind of skilled workers who become home buyers. The expansion of remote and hybrid work has accelerated this trend, allowing people to choose locations based on lifestyle and affordability rather than commuting distance to a physical office. The demographic time bomb that has loomed over the UK housing market for years is beginning to detonate in unexpected ways. The massive baby boomer generation, now moving through retirement, holds a disproportionate share of UK housing wealth, much of it in large family homes that are increasingly unsuitable for their needs. Downsizing by this generation could release substantial supply into the market, potentially easing pressure on prices. However, the process has been much slower than anticipated, with many retirees reluctant to move from homes they've occupied for decades and neighbourhoods where they've built social connections. The wealth transfer from boomers to younger generations through inheritance is accelerating, with recipients often using windfalls as house deposits, creating another demand source that supports higher prices. This intergenerational wealth transfer is extremely uneven though, benefiting those with property-owning parents while leaving others further behind, contributing to growing inequality in home ownership rates. The energy efficiency requirements that came into force for rental properties and are being extended to the broader housing market are creating a bifurcated market that savvy buyers are learning to exploit. Properties with energy performance certificate ratings of C or better command premiums and sell faster, while those rated D or below face discounts and longer marketing periods. For buyers willing to undertake renovation work, this creates opportunities to purchase below-market properties, improve them, and capture significant value gains beyond normal price appreciation. Government grants and incentive programs for energy improvements have made these upgrades more financially viable, though navigating the bureaucracy and finding reliable contractors remains challenging. As energy costs remain elevated compared to historical norms, the financial benefits of efficient homes have become more tangible, reinforcing the price differentials based on EPC ratings. The commercial property sector's struggles present an interesting contrast to the residential recovery and may indirectly impact housing markets in complex ways. Office values have collapsed in many city centres as remote work has reduced demand for workspace, while retail properties continue to face pressure from online shopping. This commercial real estate distress has negative implications for city centre vitality and could affect the desirability of nearby residential properties. However, it also creates opportunities for conversion of commercial buildings to residential use, potentially adding to housing supply in locations where new construction is difficult. Several cities have seen former office blocks transformed into apartments, helping to revitalise downtown areas while creating housing in well-connected locations. The planning system has generally supported these conversions as a way to address both commercial vacancies and housing shortages simultaneously. International economic headwinds that threatened the UK economy throughout 2023 have moderated somewhat, reducing recession risks that might have derailed the property recovery. The European economy has stabilised after energy price shocks following the war in Ukraine, maintaining demand for UK exports. The United States has avoided the recession that many predicted, keeping global economic conditions relatively supportive. China's economic slowdown has been concerning, but hasn't triggered the kind of global crisis that would devastate UK consumer confidence. Inflation has declined more rapidly than expected, taking pressure off household budgets and making the Bank of England's path toward rate cuts clearer. These international developments don't make headlines the way domestic policy does, but they create the backdrop against which the property market operates, and the improving global picture has certainly contributed to stronger than expected UK housing demand. The buy-to-let market is experiencing a renaissance after years of declining attractiveness due to tax changes and regulatory burdens. Higher rents have improved yields, making property investment financially viable again, despite elevated purchase prices and mortgage rates. Landlords who exited the market during the less favourable conditions of recent years are now looking to re-enter, adding to demand pressure. This is particularly evident in student cities and areas with strong rental demand from young professionals, where properties are being purchased specifically for letting rather than owner occupation. The political risk remains significant though, with potential future governments threatening further regulations, including rent controls and expanded tenant rights that could erode landlord returns. This creates a complex calculation for investors weighing attractive current yields against uncertain future regulatory environments. The mortgage prisoner problem, affecting tens of thousands of homeowners trapped on expensive standard variable rates because they can't meet current lending criteria to remortgage, has begun to ease slightly. Regulatory changes have allowed some flexibility for these borrowers to switch to better deals, and falling rates have made even standard variable rates less punishing than they were at the peak. However, substantial numbers remain stuck, unable to participate in the improving conditions that benefit other homeowners. Their situation represents a hidden weakness in the property market, as these households remain vulnerable to any economic shock and could face distress if circumstances worsen. The contrast between their experience and that of buyers securing favourable new mortgages highlights the uneven nature of this recovery and the way timing and circumstances create vastly different outcomes even for people in otherwise similar situations. The psychological shift in buyer sentiment deserves emphasis because property markets are as much about confidence and expectations as they are about financial fundamentals. Throughout 2023, a pervasive negativity hung over the market, with potential buyers convinced that waiting would result in better opportunities and lower prices. That mentality has flipped dramatically in early 2024, replaced by fear of missing out as buyers watch prices rise and worry that delaying will price them out entirely. This change in psychology drives behaviour that becomes self-fulfilling, as increased buying activity pushes prices higher, confirming buyers' fears and intensifying the urgency to purchase. The shift has been particularly notable among younger buyers who spent years being told homeownership was impossible for their generation, but are now seeing peers successfully purchasing and not wanting to be left behind. The quality of the housing stock being built and sold has implications for long-term market sustainability that often get overlooked in discussions focused on prices and transactions. The UK has a persistent problem with building quality, with new homes often smaller and less durable than older housing stock. Scandals involving EIMAS, age or developers delivering defective properties, particularly related to fire safety issues following the Grenfell Tower disaster, have created justified scepticism about new builds. However, demand pressures are so intense that even questionable properties sell quickly, potentially storing up problems for future years when defects emerge and buyers seek recourse. The cladding crisis specifically continues to trap thousands of flat owners in unsellable properties, creating localized market dysfunctions that contrast sharply with the broader recovery. The insurance and service charge costs associated with property ownership have escalated dramatically and represent a hidden affordability challenge that doesn't appear in simple house price statistics. Buildings insurance premiums have increased by 30 to 50% in some areas due to climate-related risks and the cladding crisis. Service charges for flats have spiralled upward, with some leaseholders facing annual bills of several £1,000s on top of their mortgage payments. These costs erode affordability and make the true expense of home ownership significantly higher than mortgage payments alone would suggest. Buyers focused on whether they can afford the monthly mortgage sometimes discover too late that the total housing cost exceeds their budget once all associated expenses are included. This creates a potential source of future distress sales if households find themselves unable to sustain the full cost burden of their properties. The second-hand market for properties has tightened dramatically, while new build sales have remained relatively stronger, creating an interesting dynamic where builders are capturing market share from existing homeowners. Major developers reported strong sales throughout the first months of 2024, with reservation rates returning to pre-pandemic levels. This reflects both the limited resale inventory available and the attractive incentive packages that builders offer, including contributions to deposits, free upgrades, and favourable mortgage terms arranged through preferred lenders. However, the new build premium, the extra amount buyers pay for a new property versus an equivalent resale home, has narrowed substantially as resale prices have risen. This makes new builds relatively more attractive than they've been in years and supports continued construction activity despite cost pressures facing developers. Looking at what this all means for different types of buyers reveals a market of opportunities and risks depending on individual circumstances. First-time buyers in northern cities and the Midlands face perhaps the best conditions in years, with prices still reasonable relative to local incomes, improving mortgage availability, and strong employment prospects. Those trying to buy in London or the South East continue to struggle with affordability despite the improved lending environment. Existing homeowners looking to upsize can benefit from strong equity gains if they purchased more than a few years ago, though they face higher mortgage rates when refinancing. Downsizers find themselves in an excellent position, selling expensive family homes in a strong market and purchasing smaller properties that have appreciated less, capturing the price differential as cash. Investors need to carefully assess local rental markets as yields vary dramatically by location and property type. The path forward remains uncertain despite the strength of the current recovery. If the Bank of England proceeds with expected rate cuts and mortgage rates fall further, the current momentum could accelerate into a full-blown boom, particularly in regions that have lagged so far. If inflation proves stickier than expected or global economic conditions deteriorate, rates could remain elevated and demand could weaken rapidly. The election introduces substantial policy uncertainty that could shift market conditions dramatically depending on the outcome. What's clear is that the narrative of inevitable decline that dominated conversation throughout 2023 was wrong, and those who delayed purchases expecting substantial price falls have watched opportunities disappear. The recovery they've been hiding from you isn't actually a conspiracy of silence, but rather a story that doesn't fit the preferred media narrative of crisis and decline. Positive economic news generates fewer clicks and less engagement than doom-mongering, so the genuine improvement in housing market conditions has been systematically underreported. The data doesn't lie, though, and the numbers reveal a market that has turned decisively positive after a challenging period. Whether this represents sustainable improvement or a temporary surge before another downturn will be determined by factors including interest rate policy, economic growth, political decisions, and international developments beyond any individual's control. What buyers, sellers, and observers can do is arm themselves with accurate information, rather than relying on outdated assumptions or sensationalized headlines. The UK property market has surprised almost everyone over the past 6 months, and understanding what's actually happening rather than what you've been told to expect makes all the difference.